Good morning and welcome to this timely FESE webinar. I'd like to thank you for joining us this morning, which promises to be a very informative discussion about one of the major topics of recent MiFID review, the consolidated tape. We know there is already heated discussion about that, and I hope today going to be a major contribution. As a FESE president, I have to start with reminding everybody what we exchanges are standing here for. We are playing central role in serving the real economy, providing capital to the companies, delivering neutrality, transparency, reliable price formation, and risk management. But our role is very important on the primary markets. We are bringing the companies to the market. We nurture those companies seeking access to the finance through the public markets. Today, we will get a presentation of newly launched study of Oliver Wyman, Caught on Tape. And we are very much looking for it. As exchanges, we welcome this important contribution to the debate because we believe that cost-benefit analysis is actually one of the first steps have to be done in any kind of project, especially such a kind of difficult project of the pan-European scale. As you will see the results of this project, first and foremost, the lack of quality of the reporting of SI and OTC trades must be addressed. Policymakers should ensure that the market structure fit for purpose. Consolidated tape cannot be seen as a substitute for adequate market structure. Let me now briefly take off my hat as a FESE president and go to where I came from as a CEO of the smaller market in Central Eastern Europe. We very much watch the development of consolidated tape with other exchanges, and we think it can undermine our efforts. With the MiFID 1 and MiFID 2 experience, which probably served perfectly for pan-European blue chips and its liquidity, we saw that it led to many cherry picking and make actually our ecosystem weaker and more vulnerable. We, together with the 13 other CEOs of the Central European stock exchanges, get it together, and actually we are very much worried about the results of the tape and about the potential effects on our market, which can be devastating. And we would like to have policymakers gathering and assess also the effect of the consolidated tape on small markets, because I believe bringing SMEs into the markets and bringing ecosystem in the smaller markets to work for CMU is one of the crucial points of the Capital Market Union. Again, I have to stress, the consolidated tape will not be fixed for all for CMU, but it can help increase the transparency, especially in systemic internalizers and OTC space. Therefore, I very much welcome the study of Oliver Wyman. Discussing these points and many others, we have a great lineup for you today, including John Berrigan from European Commission, who is leading DG FISMA and the work on this. Now I hand over to Rainer Riess, FESE Director General, our host of the morning. Rainer, the floor is yours.
Thank you very much, Peter, and welcome everybody to our webinar, Caught on Tape. My name is Rainer Riess, Director General of the Federation of European Securities Exchanges, and I will be your host today for the webinar. And let me start with some introductory remarks about the MiFID review and what we need for transparent, fair, and competitive European markets. First of all, I want to make very clear that exchanges in general welcome a consolidated tape if designed properly. We stand for transparency, and in that spirit, we are very much for anything that will help transparency to increase. And the Oliver Wyman study is a very important contribution, in my view, to make the right choice for Europe, improving transparency and avoiding the pitfalls of unnecessary costs or risks that a wrongly designed consolidated tape could bring. But let me begin my intervention by outlining what a consolidated tape will not fix and what needs to be fixed independently in order to create European markets in financial instruments that deliver for CMU, for investors and issuers. And as Peter was already alluding, I think MiFID 2 and MiFIR have been a big step forward, but they also have so far failed to address one of their major policy objectives: increase transparency and bring more trading into the light. Much to the contrary, Europe has become a much darker space. And a precondition for a meaningful tape is to address the challenges raised by fragmentation and opacity, and to ensure that a level playing field and a well-functioning price formation process to the benefit of European issuers and investors, particularly retail, exists. The challenges to this are multiple. A capital market union and a sustainable recovery from the COVID-19 crisis, in my view, cannot happen without well-functioning capital markets. And it's very important there to stress it needs to be both primary and secondary markets. They're two sides of the same coin. If we want to issuers and investors to re-enter capital markets, we need to restore trust in the efficiency, stability, and transparency of the market. And core to this is obviously ensuring that Europe has an optimal price formation process. Now, let me start by showing maybe a couple of slides, and I'll start with the first one. Today, the EU trading landscape is highly fragmented, with more than 250 execution mechanisms for equities alone. In total, it's more than 600, from which there are currently 85 SI operators. This is clearly a highly complex environment, many more execution venues than, for example, in the United States, and presents a considerable challenge, not only for price formation, but also for supervisors to ensure that there is a level playing field. Since the implementation of MiFID II, overall, we have witnessed lower levels of transparency and a drop of market share of lit trading. And you see the open order book is only around 40%, since a significant share of trading volume is still executed in the dark. OTC is around 27%, and SIs are at 20%. Dark MTF trading, to maybe mention that as well, is around 5%. These are ESMA figures, but in the slide displayed, you can clearly see that the objective of more transparency has not been delivered, and to the contrary, the dark trading has increased. So looking at these trends, in our view, the priority should be to simplify the EU equity market structure with a view to achieving more transparency, efficiency, and also fairness in European markets. Let me maybe show you a second slide, and it's a slide we used in the MiFID I and MiFID II process, and it very much shows a bit what is the difference between the execution venues. The intention to create SIs and permit bilateral trading is to allow for large trades to be taken on the book of an intermediary and shield that larger order from market impact. That is the old upstairs trading, because in the old days it was done going up some stairs and doing this upstairs in a closed room. But let's look at slide 2. This comes with privileges that regulated markets and MTFs don't enjoy. SIs can discriminate whom they take on as a customer, only doing business with customers to their liking. They need not to adhere to the same pre-trade transparency regulation. What they need to show is much lower in terms of pre-trade transparency. And also they provide today very poor data quality in the post-trade reporting. They do not need to comply with reasonable commercial basis obligation when selling most of their data. And by the very nature of bilateral trading, they can earn the spread. That is very justified for risk business in size, where they need to be compensated for committing their balance sheet. That is something that always existed, but it's a free lunch for smaller trades since there is not such a risk. If we look at the SI data in the first half of 2021, we find that about 80% of SI trades are below standard market size and have an average trade size of only 3,000 euros. 99% of SI trades are below LIS and the large in scale size and have an average trade size of 28,000. That is what I would call a free lunch and a very unlevel playing field to the detriment of functioning price formation. SIs executing small order flow don't bear risk. There is no capital commitment. And to such an extent, it is not only a distortion of the level playing field, but it's also a cannibalization of the price formation process and not fair treatment to retail investors. And we all know less liquid instruments and representative prices translate to higher spreads and volatility. But what can the MiFID review do to tackle these problems? Beyond enforcing existing rules, it is key to ensure that SI venues are held to the framework to which they originally were intended, and that is of providing for large in-scale trades. And to this aim, a tightening of the SI regime is necessary, which would include increased transparency requirements and restricted trading by SIs to the LSI threshold. Alongside strengthening the price formation process for the benefit of European companies, and overarching focus should be placed on the interest of end investors, notably retail investors. This is, in my view, critical to ensure that investors have the confidence to participate in European public capital markets. In particular, there should be focus on venues that offer zero fee trading for retail investors as well as payment for order flow regime. Some FESE members have conducted extensive research in this space to demonstrate that regardless of the zero fee offer, best execution is not achieved on these venues, proving that rent is still extracted despite the headline offer in a very intransparent manner. But let's come to the consolidated tape and let's consider what is really delivering a clearer picture of European liquidity. The first priority, in my view, is to increase data quality. Data quality originating from OTC and SI trading remains deficient, which mainly results from fragmentation, exemptions from the transparency regime, and a lack of enforcement of rules. Therefore, data quality, consistency, and availability at the source has to be improved as a matter of priority. Without doing that, SCT will constitute another data aggregation exercise without any clear regulatory use case, but an additional cost for market participants. So really, provided that the data quality issue is sorted out, we agree to an EU consolidated tape, but not one that favors certain players and places more costs on EU firms. Some players want a tape that only shows prices of transparency market, claiming that only addressable liquidity should be on the tape. This means that significant volumes of business conducted by these players will not be on the EU tape. And if the key is to see 100% of transactions, then obviously market dynamics have to be understood and have to be transparent. So through the tape, some market participants want to get market data for free and then really use this for their commercial purposes to execute orders and allowing them to internalize cheaper and earn the spread between buyer and seller. Well, that also, I think, is not the intention of a tape and should not be allowed to really do free riding on the investments of transparent markets. I think it's also important to be careful when certain market participants speak about the cost of market data. They often mean data which does not fall into the general accepted understanding of market data, as they use many other types of data. And the exchange markets data spend is actually very small. It's about 0.5% of buy side and 0.10% and about 10% of the sell side market data spend. So in short, an EU consolidated tape will not be a silver bullet for resolving the identified issues around transparency and price formation. When it comes to trading on lit venues, the majority of volume is covered by existing data providers and is available today. The real problem and the real challenge for a comprehensive consolidated tape to be in a position of adding value is the lack of data quality from the gray and dark parts of the market, as well as the fact that these parts of the market are not accessible for many investors. Well-designed tape is even more relevant for growing markets. In those regions, exchanges support the local ecosystem by bringing together the local companies with investors, and Petr referenced that. And a too intrusive consolidated tape legislation will put those markets at stake, going against the objective of the capital market unions in the EU 27. In closing, I would like to highlight again that only a coherent MiFID review fostering transparency together with a reliable and complete post-trade data will strengthen capital markets and benefit investors and issuers. An improved equity market structure and a well-calibrated consolidated tape, CT, go together. But how can we make this happen? Well, it is crucial that the design of the equity market structure takes priority and is simplified. Restricting SI equity trading to large orders above LIS only would be an efficient way to incentivize lit trading, ensure the quality and robustness of price formation, and remove the complexity currently embedded within the market. And a precondition to a reliable CT is the improvement of SI and OTC data quality. And we think that what Oliver Wyman proposes, a 15-minute delayed step, seems like a feasible option to start. We are still advocating for a tape of record, but I think both are options that probably can achieve the way if the market structure issues are solved. We need to ensure the EU is equipped with a comprehensive vision to strengthen EU public capital markets, both within the Union and on a global basis, and work with the industry to ensure that these markets play a full role in the economic recovery from the COVID-19 crisis, as well as accompanying digital and sustainable transformations. We stand ready as European exchanges to participate in this process. And with that, I turn over to Magnus Burkl. He's principal at financial services at Oliver Wyman, and he will present us the highlights of the study. Magnus, the floor is yours.
Thank you very much, Rainer. And I'll quickly also try to share my screen with everyone here. So, hello again, and thanks everyone for joining today's webinar. Over the next 15 minutes or so, I will present the summary conclusions of the report on the consolidated tape that we as Oliver Wyman have written, and walk you through some of the key considerations on that. My name is Magnus. Rainer kindly introduced me. I'm one of the co-authors of the report. I work at Oliver Wyman. We specialize in corporate and institutional banking, wealth and asset management. So we really serve the entire capital markets community. And I myself, I've worked for the last 7 years now in that space. I'm working with banks, brokers, the asset managers, but also the market infrastructures. And that was also very important for the study because quickly to the background, the study was commissioned by FESE, but it was fully independently developed and produced by Oliver Wyman. And we took really the perspective of the entire capital markets, looking at all participants on the buy, the sell side, the market infrastructures, the institutionals, the retailers, and made sure that we reflect what's best overall for European capital markets. We looked across the entire value chain, which is important because as of now, there is no regulatory-driven use case for a consolidated tape that could be evaluated. So we looked at all processes in the capital market space and looked to which extent do they use market data today and to which degree can they benefit from a consolidated tape. And what we looked at was really what's the quality of the market data that's needed for that business process. How comprehensive does the market data need to be to add value above and beyond what is currently available from market data providers? And most critically, how quickly or how timely does the market data need to be available in order to add value above and beyond what is currently there? We didn't develop this in a closed shop. We have written this independently, but we have discussed and challenged our views via interviews with market participants. And we really spoke to all different types of market participants, also reflecting different business models. And we discussed and challenged our perspectives. And in the end, we stand the way that we thought is the right one for Europe. And I can tell you some of the debates have been very heated and emotional. And lastly, before I start walking you through some of our conclusions, how we interpreted the study and how we wanted to add value to the debate is by providing a cost-benefit analysis on different tape options. And we know the debate is not new on the consolidated tape, and many options have been discussed previously, also in the public debate. And we went through these options step by step, analyzing which option is really the best one for Europe, acknowledging that there are costs involved, there are risks involved, but also there are potential benefits to be reaped if the consolidated tape is well designed. So much to the background of the study. I jump to my next slide, which is the recommendations from the report. In short, what we recommend is a 15-minute delayed consolidated tape for equities, equity-like fixed income that covers data comprehensively from all trading venues, but equally from all execution venues, be that SI or OTC. So really from every occasion where market data is created in Europe to be fully comprehensive. How to read the slide that I'm broadcasting. So you can see 4 different tape options that we have looked at: a pre-trade real-time consolidated tape, a post-trade close to real-time tape, a post-trade 15-minute delay tape, and a post-trade end-of-day tape. And then you see 4 different assessment dimensions: whether the tape improves European market transparency, whether it provides benefit and to which degree, and what the challenges and costs are for the different tape options. I now go from left to right explaining how we arrived to our conclusion, starting with the pre-trade real-time tape. And this tape option is something that we think doesn't make any sense for Europe. The benefits are pretty small, and it's technically almost impossible, very difficult to realize given the latency issues we have in Europe, the technical requirements it would need, and the high risk specifically with respect to arbitrage and the customer protection concerns it would raise. So the pre-trade real-time tape is something for us. And by the way, also no one of the 40 interview partners we had advocated for this. So this tape option is something that was sort of least preferred and ranked lowest in our assessment. A post-trade close to real-time tape has the biggest benefits, stemming from the fact that close to real-time supports the largest amount of business processes in the capital market space, but it also comes with an incredible difficult cost challenge and also realization challenges on how to implement this. So whilst it has the biggest benefits, the implementation costs and also potential risks stemming from misuse, for example, make this option our second priority option, because the costs, so to say, outweigh the benefits for the close to real-time option for now, and specifically for a first-time implementation of a consolidated tape in Europe. For a post-trade 15-minute delay tape, we find that it still supports most of the processes in capital markets. Not all the processes, some processes require real-time, but most of the processes along the value chain are sufficiently served with 50-minute delay market data, if it is comprehensive, if it is of high quality, and so on. The technical challenges and also the cost to realization are acceptable. The infrastructure for that is largely already available across the industry. So from a cost-benefit perspective, a post-trade 15-minute delay tape is our preferred option, and doing all the analysis, it ranks best. A post-trade end-of-day tape adds some value. It provides operational simplification, and there is some value to be reaped from comprehensive and consolidated data, but it's very late and supports only a fraction of business processes, i.e. only those that are carried on overnight. The infrastructure for that is already in place, and given it's an end-of-day download or drop copy, it's not very complex to realize, but the benefits are also not the greatest ones. So in summary, we found and we recommend a 15-minute delay tape for equities, equity-like fixed income, covering all trading venues and all execution venues, including SI, OTC, and other bilateral trading in Europe, for this tape to be really comprehensive and to add value above and beyond what's already existing today. Once this has achieved, and it should be really a priority to launch this now and as soon as possible, In the future, and once a 50-minute tape has been realized, we find that there is potential to shortening the delay time towards close to real time, stepwise in little increments. However, not going to real time or like ultimately close to real time in a micro nanosecond perspective, because this will again introduce technical challenges, it will introduce risk of misuse, it will raise customer protection concerns. So we advocate for a speed limit, and that the consolidated tape, even in the future, doesn't lead to a technology arms race on who has the data first and best, but that it supports more business processes, but with a sensible speed limit that is also geared towards human consumption rather than high-speed algorithmic consumption. And lastly, there should always be a strong benefit case for a consolidated tape. And depending on the implementation and future development, new developments, enhancements shall only be done once a 50-minute tape or a shortened tape has provided value to the industry and more investment is justified, because it will come back to all market participants who will need to implement, who will need to act and include this in their business processes. So only move ahead and do further investments if the benefits have been realized and the tape has been proven helpful and beneficial. Lastly, on our recommendations, we find that this is really a critical element in European market structure and also in capital markets, because market data today powers all business processes and is intrinsically linked to value creation for most stakeholders in the capital market space. Hence, governance and enablers for the consolidated tape are equally important to get right for a tape to be well designed. Given the importance, we think someone independent and pan-European, for example, ESMA, should run the tape and administrate the tape. There should only be one provider over the midterm and one CT per asset class to make things less complicated. The industry, both the contributors and the users, should sit in an advisory group and helping to form and shape the future direction of the consolidated tape. Thirdly, the consolidated tape needs teeth. It needs to be supported by regulation, by legislation, and by the NCAs to enforce data quality standards. With low quality data or non-comprehensive data, the CT does not provide any value above and beyond what's currently available. So it needs to have teeth and the support to really gather the comprehensive and high quality data that it needs to provide value. We think the consolidated tape should also have a revenue and a commercial business model so that we can actually measure whether users want to sign up and pay for the data. And it shall also be used to compensate the data contributors for their cost in contributing the data, notably the price forming data here. And at a certain calibration, this shall be redistributed to the contributors, but also reflecting overall the need to offer the consolidated tape data at a reasonable cost. The technical setup is important. There are solutions out there on the market that could provide such a technology. This is not the first consolidated tape that has been built around the world. So instead of building this as a European island solution, we suggest that a best-in-class technology is used, provided by a specialized vendor in Europe for this tape really to live up also to the technical standards and also simplify the connectivity to users and contributors via technical standards and interfaces. One word of caution on the consolidated tape debate. A consolidated tape, if well designed, can bring significant benefits to European capital markets. Better access to comprehensive, high-quality data. Improved outcomes for almost all capital markets processes, ranging from investment decisioning to ultimately risk compliance management and further processes. And also, it will reduce operational frictions that currently exist because institutions are using different market data that leads to process cutoffs, etc. So having one source of consolidated data will simplify things for market participants a lot. On the other hand, a badly calibrated tape will not just be a failed initiative. It will actually worsen the status quo. It will increase costs for market participants, the users, and the contributors. And ultimately, this will fall back onto investors and issuers who bear the cost of this. It can harm market integrity and lead to customer protection concerns. If some very sophisticated market participants have better market access via direct feeds quicker than the consolidated tape, there's potential for gaming and arbitrage in the market that is created. Low quality market data can lead to financial stability concerns because we all remember the financial crisis. We need good market data and good information to manage risks appropriately. And overall, it will set back the European integration quite significantly. So the stakes are high, and there needs to be a strong focus on calibrating the tape in the right way, because if it fails, it will not just be a failed initiative, it will worsen the status quo. But there are also significant benefits to be realized if we get this right. Last slide from my end, and that's also a note on European market structure and critical dependencies that exist for a consolidated tape to work. Rainer mentioned this in his speech. Currently, there is significant fragmentation across venues in Europe, not only the regulated ones, but also bilateral trading. There's huge geographic dispersion in European markets. If you go from north to south, from east to west, it's just a very long distance that has implications also for latency. Data quality is poor from some areas of the market, specifically if we look into bilateral trading. Deferral allowances are long, and all of this is aggravated in fixed income, where we think the data quality challenges are the worst. A consolidated tape will not help to cure these problems in European market structure. The introduction of a consolidated tape will not help to reduce some of these problems. The other way around, if these problems are not solved first, a consolidated tape will not provide the value that we think it will provide. And if these problems are not solved, the consolidated tape will probably just increase cost. And you heard my note on the potential risks of a consolidated tape. So it's really important that these things get addressed before or simultaneously with introducing a consolidated tape. Otherwise, the stakes are high and the status quo will likely worsen. This was it from my side. I stopped sharing the screen and I saw there are a few questions that have come in.
Yeah, I think
we'll pick them up in the panel later today.
I think we'll pick them up in the panel as we're already running a bit late. So thank you very much, Magnus. And I think I would welcome my next two guests, John Bergen and Thomas Burkl. Welcome to the two of you for our early morning fireside chat, but temperatures are getting cooler outside, so I think it's probably okay to say it's a fireside chat. Both don't need introduction, but just to say John Bergen is the Director General at DG FISMA, obviously responsible for EU-level policy and making the legislative initiatives in the respect of the financial sector, banking union, capital market union, sustainable finance, digital finance, anti-money laundering, etc. I think that's what John stands for. And Thomas Burkl is a member of the executive board of Deutsche Börse Group, and he's responsible for trading and clearing, so Xetra, Eurex, the energy markets, foreign exchange, including market data. With that, I would give Sean the floor for a few introductory words.
Thanks, Rainer, and very happy to be here to discuss the consolidated tape in the context of the upcoming MiFID review. I think it's very important for the future of the market, and so it's useful to exchange views with stakeholders concerned, particularly those around the exchanges. But before I focus on the consolidated tape more specifically, I want to make a few more general remarks, because you've mentioned that I have a slightly wider portfolio, and I want to say a little bit where this fits into that wider portfolio. The Commission, as you know, will present an important CMU package by the end of this year, probably towards the end of November, and that package will comprise 4 parts. It will have the European Single Access Point, that's about access to data on corporations and small and medium-sized enterprises. The LTIF review, which is looking at making this more attractive as an instrument for wholesale and retail investors. The AIFMD review, which is looking at, I think, tweaking the rules rather than reforming dramatically the rules for alternative investment managers. And then, of course, the MiFID review, which looks at capital market functioning and is the vehicle for any proposal we will make on the tape. Now, this overall package is for CMU is very important, because it is the first set of legislative proposals that we're going to make under the new action plan. And I think it's also important because it's going to bring CMU back into what I would say the political limelight after a period of kind of behind the scenes preparation work. Our focus has been a little bit otherwise, attracted by other things on the agenda that you mentioned: sustainable finance, digital finance, AML, solvency, Basel. This will be the moment when I hope we can bring CMU back into the light and build some momentum behind it. So this is going to be an important discussion. And within that package, the MiFID review is going to be very important, and of course is the main focus around this event today. I have to say, if I'm frank and open, I find the debate around the MiFID review has become a little bit what I would call tape-centric. I mean, this is understandable, I think, given the sort of the novelty of the CT proposal, but I want to stress that this review is about the broader efficiency and functioning of the EU capital markets. Okay, so there will be more in the review than just a proposal on the tape, and that's important because there is this discussion about what comes first and what should come after. We don't think there's really either or here. Now, the consolidated tape is a key action under the CMU action plan. But it falls under a particular heading. It falls under the heading of the economy that works for the people. So this action is clearly focused on the benefits to the end investor, big and small. So any implied changes in the functioning of the markets due to the tape is a means to an end. So it's not an end in itself. So we want to focus through. And with any measure that is focused on the interest of the end investor, we of course need to find balances between various dimensions. So cost efficiency versus competition, choice versus transparency versus protection, etc. There's a whole range of dimensions where we have to find a balance in the proposal, and we will try to find that balance in the proposal that we put forward. Now, I fully acknowledge there are differences of views on this. I've just listened to the end of the presentation on the study about what we need, about how we need to proceed. Although I think it's very good that we seem to have now all at least coalesced around the view that there are economic benefits to the end investor from a tape if the tape is well designed. That's already, I think, an advance in this debate relative to where it was not so long ago. But from our perspective in the Commission, we believe we have to be ambitious about this proposal for a number of reasons. I mean, firstly, Brexit has had major implications for the remaining CMU 27 capital markets. We are now behind competitor markets in terms of development. There is no doubt about that. So we have to work extra hard to make our markets an attractive place to invest, not only for our domestic investors, but also we want to attract investors from outside, investors who may be even more interested in choices between us and competitor markets. I think the emerging consensus among stakeholders, both public and private now, is that CMU 27 will be multipolar. So we will not try to replicate the City of London inside the EU 27. This is fine, but it does mean that our market infrastructure will remain relatively fragmented relative to the past and relative to competitor markets. So we have to exploit, in my view, technological solutions ambitiously if we're going to compensate, I should say, for implied loss of agglomeration benefits that we had and other markets still have. So that's why we favor an ambitious approach to the tape in addressing two main objectives in terms of market functioning. First, we want a tape to assist investors in intraday liquidity. So we want them to be able to identify the best place to execute trades in terms of liquidity. So we want to use technology to compensate for liquidity fragmentation across a wide range of infrastructures. And by the way, we're not talking about nanosecond tapes here. We're talking about tapes that deliver within seconds, but not within minutes, but not nanosecond tapes. And second, of course, we want to ensure maximum protection for investors, so typical best execution requirements, so that investors know that they have in fact had best execution delivered by their intermediaries. So, to put it bluntly, while the 15-minute tape proposed in the study would address the second objective pretty well, we don't think it would address the first objective well at all. And if we zoom out a little bit and take a more strategic perspective, we believe this more ambitious approach is needed because our competitor markets, the two big ones we now have, either have a tape already and are actually improving it, or seem to be moving pretty fast to develop a tape. So we need to move in line with our competitors. All this being said, we know there are differences of view out there, and we have to acknowledge that there are some complications that this kind of must be taken into account when we discuss the tape. I mean, the first complication is that there seems to be no consensus out there on exactly how capital markets function. I mean, the main problem here seems to be a quality of data problem, not for the first time. So we find ourselves with different studies using apparently the same data, but reaching very different conclusions about how the market actually works. So we've seen the study I've just seen the end of now, the FESE one, which thank you very much for sending to me. But we also have other studies which reach very different. And so we are at conclusions, and we are trying to balance these studies to come up with a sort of balanced judgment. Now, interestingly enough here, almost paradoxically, the tape would help to resolve this problem, because if there's a body empowered to set and enforce standards around that tape, then we would expect the quality of data about how the market's actually functioning to improve. A second complication or consideration is that we know the tape will have implications for the business models of many infrastructures. I mean, we've known that has been made clear to us. Many of these infrastructures rely on the sale of data as a revenue source. So we have to recognize this fact, and we will recognize that fact and take it into account in any proposal that we put forward. A third consideration is around governance. I must say, and you know me, I ideally favor competition in these markets. So I would like to think that this is another market we can have competition in. I'm not at all sure that a single provider is the first best option, but let's see what we can deliver. And then lastly, there is this view, and it's again, I think I just picked up the end of the study, that we should sequence things. So we should look at market functioning and market structure before we introduce the tape. Again, as I said earlier, we don't see it as an either or. I mean, I think we have to do both together. I think we cannot really reform fundamentally the market structure if our understanding of how the market actually works is still clouded by poor data quality. So, but for that reason, I'm going to repeat it, that we can't kind of do one or the other. I think we have to do the consolidated tape and look at the market structure at the same time. And again, I'll stress here that the MiFID review that's coming is not just about the tape. There will be other things in about the market structure as well. I think I've already probably gone over my 7 minutes, Rainer, so I will stop here in the interest of decency and respect of time, and look forward to the discussion that comes later. Thanks. Rainer, I think you're muted.
I am muted. Thank you, John. Well, thank you very much. And no, I think all very clear and informative. And Thomas, would you kindly outline maybe your views before we start chatting a little bit on what the EU is facing and what needs to be addressed?
Yeah, I'm happy to be doing so. Good morning, everybody. And thanks to FESE for organizing this webinar. I think it is very important to exchange views and discuss it. And John, it's very good to listen to you and your thoughts. Actually, I think they are pretty close together, and it's good to probably review some of the points that you have mentioned, so we can keep this really as a chat. I think it is very important, as you have started, John, to start with what is the bigger picture, right? Because as you rightly said, it's now all here so much focused on the consolidated tape. I think there is a reason why this is so, because it really crystallizes a lot of the issues that we have in the market structure. But let's take a look at the bigger picture. And of course, the bigger picture that we look at is after the sort of crisis from Corona that we had, we are focused on economic recovery in Europe. That is the overarching perspective. And we are faced with huge challenges that are of a transformative nature. There is the move into sustainability. There is the move into digitization, which will be challenging for Europe. And as you rightly mentioned, there is, of course, the geopolitical change with Brexit now moving out and pressuring the EU further. I think very clearly the role of capital markets will be critical for our future. We see the banking sector very constrained in their financing capability. We see the public debt levels, which constrains the public sector. It will be crucial to reactivate equity-based financing for Europe going forward. And that is why I can only say it is really very encouraging to see that the Commission is bringing forward again now the Capital Markets Union Action Plan. It is so important that we keep up in Europe and that we focus on the capital markets. And I mean, I think very clearly everybody sees, given that Europe is made up of 27 states, union is important because we have a structural disadvantage to other large economies like China or the US there. If we look at where we stand, and Rainer has shown that, I think, briefly and very catchy numbers, after MiFID, I think the state of the secondary markets, also of the financial markets in Europe, is weak, and it is weaker than it could be. We have a very high fragmentation that is out there with more than 250 venues active in smaller markets than in the US, but we have much fewer. And we have a very high rate of dark trading or OTC trading, which is critical for a point that I will later briefly touch on for the price formation. We are in Europe at 45%, and the US is at certainly 65, even in Asia we see 80%. And you quoted, and you said, Jean, you know, we look at these different studies with very different numbers, and I can just recommend and really put at the heart of the Commission, look at the market structure report from ESMA. I think it sheds a lot of light on what the market structure looks like in Europe after the MiFID requirements. And I think we have to conclude that MiFID weakened the price discovery, weakened transparency, very contrary to what originally was designed. And I really agree with what you've said. It will be critical, and I'm here in the exchange sector for more than 20 years, to make the financial sector service the end client and also the real economy going forward. I think that is why it is so important to strengthen transparency in our markets and also strengthen best execution and other principles which are really not working. And let me speak briefly about the consolidated tape now as a topic. And as I stated, I think, John, if you sort of implicitly a bit allude to, that is quite a emotional debate that is coming up here. I think the reason is because it really crystallizes some of the market microstructure issues that we face in Europe. And Rainer, I think, has spoken to it. I think, first of all, if we talk about a consolidated tape, it is important to think about what is the problem that we want to cure. And it is a great tool of further integrating the European markets. That is why I also am very supportive of it. But as you stated, it has to be designed in the right way. And for me, the first requirement is, if we do it, it has to improve data quality and data availability if we launch such an effort. And if we look at the current state of affairs, of course, if we look at the exchanges, we are having the highest level of transparency. All the exchange data order book is available after 15 minutes for free. We are sort of the advocate for transparency in the markets. Yet we have a growing segment of the market that is opaque, that is OTC, that is done in SIs, that does not contribute to the price formation. And I can only say this is really dangerous. And I think some of the concern is that the consolidated tape might even worsen the situation by having less and less transactions contributing to the price discovery process. And if you run an exchange, in the end, it is about, I mean, people don't want to show their trading interest, but they want to know everybody else's trading interest. You need to find the trade-off that, of course, people need to contribute to the information efficiency of markets. So I think, first of all, the target really has to be to commit also the SIs, the OTC market, to the same data quality. And I mean, we have heard earlier the plea towards a 15 minutes delay tape. I think that is certainly a feasible first step to create a balanced level playing field here. I think the second topic is, what is the cost-benefit analysis that we look in here? And you also briefly alluded to it. So what is the effort, and how will it sort of be implemented, be governed? I think here again, it should be, we can look at other jurisdictions. It should be in a realistic, feasible attempt the way it is rolled out. I think it is very important to have a full coverage here, but also to have something that can be implemented without not putting a great burden on smaller marketplaces, and with also including the key scope of what is out there. So I think I can just say, John, overall, I think there is alignment on the objectives that the Commission puts out. It is also encouraging to hear you. I mean, don't forget, look at the bigger picture. The Commission will come up with a broad view. I think we see here this topic as being very central also to the question of how do we strengthen the market structure, and how do we make, in the end, equity funding work better? How do we then also in the end contribute to have more IPOs, to have smaller companies go to the exchange, and also contribute to the objectives that I mentioned earlier? With that, Rainer, back to you. And again, you are in the muting trap.
Again, I'm muted as no, thank you very much. And I think hearing the two of you, it's a little bit probably about the vision. Where do we see Europe in 5 to 10 years? And I think you both alluded to it, John, with the CMU package to be delivered later. And I think Thomas, you also spoke about how to be competitive as European market. That's probably because we'll discuss the details of the tape and possibly market structure a bit in the panel afterwards. Let's really discuss probably about that. Where do we need to go? I mean, where do we need to be in 5 or 10 years? John, you maybe want to react first.
Where we need to go. I think before we decide where we're going, as I think both Thomas and myself have mentioned, we have to understand where we're starting from. And there is a decision that has been taken, I think, by stakeholders, as I said, public and private, that we are not going to try to replicate sort of the City of London or replicate New York. So we are going to live in a world where we will have multipolar CMU. That has certain implications. I mean, I see in the questions coming to me, one of them is around supervision. It does have implications for supervision, because we cannot have a single market with multiple points of entry where regulation and supervision is different. So that's one area where we have to look at. The other is, of course, we have to compensate for what we might lose in terms of positive agglomeration effects. And we know that there are agglomeration effects, the financial theory going back a long way. However, we do have technology. And technology is one way that we can, I will not say compensate fully, but we can mitigate the effect. And the tape is one example of that, where you can replicate the effects of agglomeration in a fragmented liquidity environment by using a piece of technology, which is the tape. So it basically replicates. So I think this is what I mean by technology. This is where we will have to go. We have to accept that we are not going to move to a sort of single financial center arrangement. And therefore, we are going to have slight novelties in the way we approach things. And Europe has always a bit relied more on technology than other markets anyway. We will continue to rely on technology. And then we will need to have balance. As I said earlier, we need to sort of balance the various objectives we have. We obviously want Capital Markets Union to contribute to growth in the economy. So therefore, we need very efficient markets, very cost-efficient markets. We also need to protect investors. That was the idea of MiFID in the first place. It was to ensure that all investors, big and small, can operate in this market efficiently, but also safely. And there's always these trades-off between that efficiency and the safety. And then the third thing I want to say is that in deciding where we go, we cannot forget that we have competitor markets. And Thomas mentioned the US and China, but unfortunately, or fortunately, the United Kingdom is going to be a very proximate competing market, and a very big one. And we must keep an eye on what they are doing in terms of this balance between lit markets and darker markets for the bigger players, etc. So I'm not one of those people who tries to tell you where we're going to be in 5 years. I think markets evolve. What we do in the Commission is set frameworks and let markets evolve as they wish. And the framework we want to provide is one which is balanced in terms of these objectives of growth, investor protection, for efficiency for big and small investors. So these kind of balances we have to find within the context, of course, that we are a bit of an experiment here. We are going to try to produce a capital market with a lot of infrastructures, not just trading infrastructures, by the way, a lot of other infrastructures as well. This is an experiment. And that means we are going to rely more on, I think, smart technological solutions, well designed, I fully accept. And I don't hear from Thomas really any fundamental disagreement in terms of those objectives. We may disagree on the means to them, but not on the objectives themselves.
I think if I may react, right, since this is a chat, even though we have no fireplace, John, I think the wording that you are using on Europe will always be multipolar, right, and fragmented. Actually, I think it is a strength of Europe that we are decentral if we play it in the right way, right? We will have different financial centers, Frankfurt, Paris, Amsterdam, Dublin, others out there. It can be a strength, and I wouldn't call it fragmentation, but rather really a decentral industry structure that we will find here in the financial system. The fragmentation that we do see is exactly playing into your statement of, you know, that the tape has to contribute to find the best place to execute. And the fragmentation in Europe currently is across venues. It is no longer really across national boundaries, right? We have really a lot of transparency in the large exchanges, but the fragmentation is driven by many, many venues to execute, a lot of opaqueness on what is the execution. Rainer, for instance, initially mentioned, for instance, the payment for order flow topic. It takes away competition on places to execute by having sort of payment for flows from retail clients. So I think there are structural issues to be addressed to increase a level playing field that is currently not there, and not to further foster that there are sort of internalization efforts based on a sort of very transparent reference markets, which are losing sort of gradually volume and relevance. I think that is really a danger. And that is why, I mean, you said we have no consensus on how the market currently functions. I think it is so important to really analyze how the market currently functions and how we benchmark is to exactly address the topics. And I think that we are just, I mean, seeing the same objectives now on the 5 to 10 year horizon where we need to get to.
Well, maybe my last question goes a little bit to that. 1986, the UK went from a dealer market structure to, I think, a transparent lit market structure. And later on, they were quite instrumental in shaping MiFID rules. I would say MiFID even has, shaped markets, even though it maybe tried to provide that framework, as you said, John, but where we can see it incentivized more dark trading to come to Europe. So I think a different development to other jurisdictions, as Thomas said. Now we see the UK is derailing from MiFID rules with wholesale concentration. And John, maybe a difficult question for you, and I'm not sure you want to comment here, but Thomas, is that maybe, I mean, if I see those development, the US going the route of much more transparency, and that's, I think, the discussion that they're having around the tape and market structure. The UK probably going the route back to a dealer market model. Thomas, how do you see that?
I can just say I think John has very shown that the Commission is very closely watching the developments, very well aware on what is going on, and I think also the deviation that we see in the various markets. And rightly, I think you point into the sort of regulatory arbitrage and the pressure that comes from UK if the rule books deviate, and it's a bit a sad outcome, the Brexit vote, because it in the end weakens Europe as a financial center. But I think the awareness of that is really important, that we in the end sort of try to again get back to a balance that we need to strike, right? And again, what you said earlier, I mean, the agglomeration benefits that you alluded to, that of course directly speaks into how do you design an exchange and a market, where of course you need to find the right balance of, there is a reason for exceptions to transparency, for large orders to be executed outside sort of a transparency requirement, but the balance of course has been lost. There is the other side of agglomeration benefits. The more supply and demand, bid and ask you of course have in a public order book, the better the price quality is, right? And I think that balance of course needs to be re-established.
Sean, any reaction?
No, I mean, as Thomas said, we are watching quite carefully what's going on. I don't think we should abandon the objectives of the original MiFID, which was to improve transparency in markets. That would be a mistake. On the other hand, we also have to accept that there are roles for different types of venues in any market. So the question, I think, as Thomas exactly put, is how we find the balance. What is the exact balance that optimizes transparency in the market? Not maximizes, but optimizes transparency. That is the issue. And I think the US and the UK are both struggling probably to find the same outcome. And they may choose different approaches depending on what their own ultimate preferences and objectives might be. We will do the same. But I want to be clear that any sort of solution we find in terms of technology, be it a tape or other technological solutions, must cover the whole market.
Yeah.
Cannot differentiate between venues. There is a market and there are venues on which that market occurs, takes place. Yeah. Any solutions we find, us, the regulatory side and the market itself, must embrace all parts of the market. So we're not suggesting in this tape that parts are left out or parts are brought in. It will cover the whole market. It will bring transparency that is optimized for the whole market, and that would be the objective. What the UK will do is something we must keep an eye on, because they are a competitive market, but I don't think we're going to be in the business of surrendering our basic objectives just because the UK go a slightly different way.
Very well. Well, thanks a lot for that early morning intervention. I think it was highly informative for me, and I think a very good start for our panel discussion, where we'll delve a little bit into the detail. Thank you, Sean. Thank you, Thomas. And I welcome my panelists. And I think we already heard in the morning, the European trading landscape is significantly fragmented, and there is need for comprehensive consolidation. And obviously the CT then comes at the right time. Let me introduce my panelists in alphabetical order. Stephen Berger is Managing Director and Global Head of Government and Regulatory Policy at Citadel. He leads the firm's engagement on legislative and regulatory initiatives. Welcome, Stephen. Then Markus Ferber probably doesn't need much introduction. He is in the Econ Committee, has been a member of Parliament since 1994. And as a rapporteur for the recast of MiFID, he has been in the EP's lead negotiator for one of the key pieces of the post-crisis financial markets regulation. And no wonder many call him Mr. MiFID. Next, Tilman Lüder. He's the head of the securities markets unit at DG FISMA since 2014, bringing many important files, most recently the recovery package to fruition and shaping the EU securities market. And certainly he also deserves probably the name Mr. MiFID MiFIR from the Commission side. He's been working all summer on the MiFIR impact assessment. Next, Björn Sibbern, he's president of European Market Services, and he works very closely across all of the Nasdaq's European markets, but in a previous life, he was heading for Nasdaq, the Global Information Services based in New York, so he also knows very well the tape on the US side. And last but not least, Santiago Jimenez, he's general manager of BME market data and responsible there for the production and management of all market data coming from the trading platforms of BME Group. So welcome very much. And I first would give the floor to Marcus to maybe give his reflections on what's worked with MiFID II, what needs to be in the MiFIR review. Welcome, Marcus.
Thank you very much, Rainer. And I will not go in this trap, as I was carefully listening, of course, what the general director has said already, Sean Berrigan, and of course I will listen what Tillman will tell us. So I want to give you some ideas about the study you have presented, and of course of some questions I think we should put into the center of the discussion by discussing a consolidated tape. Because the study makes one aspect very clear. If we go for a consolidated tape, we need to get it right. I think that is what we have in common. But how do we get it right? I think if we ask ourselves three fundamental questions about objectives, preconditions, and governance, we might be getting closer to the answer, and that is what I would like to concentrate on. The first question we should be asking ourselves in relation to the consolidated tape is, what is the objective of a consolidated tape? Surely having a clear idea of what we want to achieve will inform the design choice. In my opinion, the consolidated tape has to fulfill more than one objective. On the one hand, it can be a handy supervisory tool for ESMA and national competent authorities to get the full picture of what goes on in the markets. On the other hand, a consolidated tape should make life easier for all market participants, as access to a high-quality data stream provided at a reasonable cost basis will level the playing field. That in turn will be particularly beneficial for smaller market participants. Of course, having the full picture should also enhance the price formation mechanism, particularly in markets where a lot of trading happens off exchange. In the EU, there is unfortunately quite a lot of markets, and that was addressed by you, Rainer, in the introductory remarks, and I fully share that. The second question we need to ask ourselves is, what are the preconditions for a consolidated tape that can achieve the objectives I tried to outline? The central requirement for a consolidated tape is getting data quality up to standard. If we consolidate shoddy data, the result will be a consolidated tape that is also shoddy, and that is of little benefit of the users. That is why getting data quality up to standard is a pivotal factor for a successful consolidated tape. The study makes quite clear that the biggest problems in that department can be found with SIs and on OTC venues. So therefore, it's very helpful. Part of the data quality issues we can probably fix simply by having another look at the relevant MiFID II RTS that deal with the data reporting and with the actual reporting templates that go with it. Right now, those templates still leave too much room for inconsistencies. However, getting the format right is ultimately a technical problem that can be solved, of course. The other equally important factor is enforcement. In order for a consolidated tape to work, increasing and maintaining data quality has to become a priority for supervisors. Right now, most regulated markets deliver useful data that are in line with MiFID requirements. The same is unfortunately not true for many smaller venues, often systematic internalizers and dark pools. We need to come to a point where delivering shoddy data becomes a painful experience for investment firms because it comes with the risk of a noticeable fine. The third question is, what should the governance structure look like? I know that most market participants would love a free of charge, high quality data stream on time, probably, but I think we should be realistic. Everyone supplying and consolidating financial data will incur some costs, and should be properly remunerated, for example, via a share of the overall revenue generated by a consolidated tape. If we do not allow the consolidated tape provider to earn a reasonable return, we can write off the idea of private sector data providers running a consolidated tapes and perhaps even some competition in that area. While I'm generally in favor of a private sector solution, a public sector solution with ESMA as a guardian of the tape would be conceivable too. If we entrust ESMA with the task, though, we need to make sure that the tape is viable commercially, otherwise we would end up subsidizing the consolidated tape with taxpayers' money, which would be less than ideal. In any case, if you manage to find convincing answers to all of those three questions, I'm convinced that we will end up with a consolidated tape that is useful for all involved parties. The study that we are discussing today certainly provides useful food for thought on this debate. So thank you very much for your attention.
Thank you, Marcus. And maybe I would give Tilman the floor to react to the study and what Marcus has said. Tilman.
Yes, good morning, everybody. And it is indeed welcome that we have added yet another study to the panoply of studies that we already have on the consolidated tape. I mean, we commissioned our study as well. Now we have Oliver Wyman. And soon you will be pleased to note we will have the Commission's own study adding onto this pile of studies. Our study is called the Pre-Regulatory Impact Assessment. We have looked at the study, and there are a lot of stuff in there with which we agree. It's good to see, first of all, in that study that the debate has now moved forward and that there is an acknowledgement that a market data consolidation can have a positive macroeconomic impact and that a market data consolidation can actually achieve our objective of moving closer towards a true capital markets union. And as Sean has said, it is basically technology that will allow us to create a virtual integrated market. We don't have to consolidate all the trading platforms. We can create a virtual marketplace by virtue of such a tape. So first of all, congratulations to the study. It acknowledges that this is a cornerstone of the CMU and that this is necessary if you want a truly competitive and integrated capital market, which serves big and small issuers. We also agree with Oliver Wyman that market data quality is a key ingredient, and as Marcus already said, for the operation of capital markets as such. Opaque capital markets which are marked by information asymmetries, do not perform well, do not create trust, and do not attract investors. So creating more information parity, creating more accessible information on big and small issuers across the European Union promises to stimulate capital markets, promises more issuances, promises more IPOs. Diverse and highly diversified secondary markets obviously will be good for also primary market issuance. What Oliver Wyman doesn't mention that much, and what we will be stressing a bit more, is access to the market data, issues of market data licensing. Because I think there are two things. There is indeed the quality issue. There is indeed the issue that reporting is confusing, that the reporting templates that we have are not fully fit for purpose for a consolidated tape. That's absolutely true. But there's also the licensing issue. Access to data, especially real-time data, is a complicated affair. Licensing is complex, auditing and monitoring is complex, and our conclusion is that on the basis of current licensing practices, it will be impossible to build a consolidated tape. So one ingredient is we need to simplify licensing. We need to simplify the contribution process to the tape so that the tape can actually operate. So data quality and licensing are at the forefront of our impact assessment. The consolidator needs to be just that. It needs to be a consolidator. It doesn't need to be a data cleansing organization. It doesn't need to be a data reconciliation organization. The data has to be clean. The data has to be usable from all venues, off venue included. and the licensing has to be crystal clear. It's a mandatory contribution. That's the key to have a tape. Afterwards, as Marcus also stressed, there can be revenue participation. There should be revenue participation, but these issues come after the tape is actually commercialized and produces revenue. Trying to sort these things before the tape has produced revenue would be an error. Finally, we do acknowledge SI and OTC data is the big obstacle here. I think everybody has to sing from the same hymn sheet. And I think that a sort of specific subset of core market data points that have to be reported to the tape across all the venues is actually key to success. So we will have to review our current data reporting standards, the famous RTSs, and we will probably, within those RTS, have to create a dedicated subsegment of very clear core data fields that have to be reported to the tape. Looking at the entirety of the fields can be confusing, and especially the post-trade flags. So I think there's a lot of good stuff in the study. Maybe in the course of this debate, we touch upon some of the other estimates about speed and cost. It would have been good if the study would have revealed what the cost data are based on. It would have been good if the study would have given us the sources of people who have estimated these costs. Our study, I can promise you, will have cost estimates as well, and all the costings and all the estimates on operating cost, capital cost of various models of consolidation will be sourced, and the companies that have given us the information have agreed that their name is revealed in the study so that everybody can check up whether these figures are substantiated. So on cost, I personally think the study makes a couple of assumptions, gives a couple of ballpark figures, which which may need to be substantiated a bit, because they're sometimes very much, well, let's say they're higher than what we have gotten from a variety of providers of such a tape. But that's a quibble, that's a detail. We can sort of maybe have a debate on that as we go on in this panel. Thanks a lot.
Thank you. And then maybe to Stephen. Any views on the study on what should the ideal CT look like?
Thank you. And thank you for the opportunity to share our perspectives with you all today. So, I think it's very heartening that we're, largely acknowledging what the benefits of a consolidated tape will be. And in our view, that includes fostering greater confidence among all types of market participants by removing information asymmetries, confidence of investors large and small, confidence of market makers who are providing quotes on exchanges. So, it'll ensure liquidity providers can better manage risk and in return more confidently quote and commit capital across all market conditions. And that added confidence for both investors and market makers will enhance the resiliency of liquidity, especially in volatile market conditions. And it's really bringing that confidence in prevailing price levels, making sure that prices are fully informed. That is what is going to help make markets more efficient, improve pricing, and deepen liquidity. And there's really no question in our mind that knowing the details of the last trades that have occurred across the marketplace does inform quoting and trading decisions. So it's a very important input into the decision-making process that occurs at investors and at market makers. And so I think, as has already been noted, that's why it's essential that a consolidated tape be comprehensive with mandatory contribution from all trading venues, APAs, SIs, etc. So as noted, it should capture the whole market. And in Europe, there's no question that there's a conscious decision to allow choice and competition in venues. So in the equity space among regulated markets, MTFs and SIs, and the non-equity space among MTFs, OTFs, SIs, and pure OTC. But that's what makes a consolidated tape even more important, to stitch all that trading activity back together in a place that's accessible for all market participants and as close to real time as possible. And again, when you have that, you can call it fragmented, you could call it diverse. When you have that landscape, making sure that 100% of the transactions that occur are then brought back together, is essential for both investors and market makers. So, we can go into more detail about the use cases, but, for investors, we mentioned it's important for them to have confidence in prevailing price levels. Many aspects of the portfolio construction, monitoring, and rebalancing process are informed by having access to this comprehensive data. It informs individual trading decisions. Do I buy at this level? Do I sell at this level? The assessment of liquidity conditions. Do I buy now? Do I buy over a time frame? Do I do a sort of volume weighted average price trade over a course of a certain amount of time? And what size do I want to put those orders out based on the prevailing liquidity conditions? And then, ongoing risk management. Like all those types of activities rely on access to comprehensive real-time data. And on the market making side, the willingness to commit capital across all market conditions is predicated upon having confidence in the accuracy of prevailing price levels. So updating quotes, keeping quotes tight, managing risk for market makers all depends on reliable access to market data. And one of the items that I think has been brought up that I think is interesting is there's this question about whether this greater transparency is going to help or hurt quoting on lit exchanges. And I actually would argue that if you want market makers to quote even more on lit exchanges, which is I think an objective we all share, more transparency into all the activity that's occurring across the market is key. So I actually think bringing the activity that is occurring, quote unquote, in the dark, either on dark MTFs or on the SI activity, getting all that information together with the executions that are occurring on exchange, disseminated in real time in one place so that the whole market sees it at the same place, will actually increase the confidence with which market makers quote on exchange, not lead them to do more off exchange. I think we'll probably talk in greater detail about the different design elements. I think, and so I'll save my comments there. But I do think that for a lot of these benefits to be realized, and for a lot of the use cases I've cited for both investors and market makers to work, there is it is essential that the data be near real time as opposed to delayed by minutes or hours. Again, as others have noted, we're not talking about nanoseconds here, but we're talking about, as near real time as is feasible. I think there's a lot of challenges that have been cited, but I think, this consolidated tape can help solve them all. So, I've already commented about how it stitches together what some would say is a fragmented market. To the extent that there's a view that markets have become less transparent, it makes them more transparent. And I think it does address, data quality issues by enforcing certain standards, at least with respect to the core data that Tillman just referred to, that's going to be identified and it's going to be the basis of what's consolidated. The last thing I'll note is that I think this conversation has largely been equities focused, but the benefits of bringing consolidation of data are not limited to equities, and I think, in fact, are probably even more pronounced in the historically opaque non-equities markets, including for bonds and OTC derivatives. So, I think there will be, ideally one consolidated tape per asset class, and there's going to be, some differences in calibration that's required for each of those asset classes, but I think, the benefits we see are not limited to equities and should be realized across the full panoply of European capital markets.
Björn, use case of the tape. What sort of do you see as the main objective, as Marcus was saying? What should a tape be used for? Why is it good for Europe?
Yeah, so let me start by saying that from a Nasdaq point of view here in Europe, we have been positive towards a consolidate for quite a long time. And I like the study that we have seen from Oliver Wyman. I think it adds a lot to the discussion. It has a lot of interesting data points and also adds to the discussion. I think we all agree we will have a consolidated tape. We should have a consolidated tape. We just need to get it right. I heard a couple of comments from both Tillman and Marcus that it is super important to have the right quality of data. And I just want to stress that part. It is super important. It is key part of a consolidated tape. And I don't think it's that easy. Sometimes it just sounds like to get the right quality, yes, it's a must-have and it's easy. Remember, to build a consolidated tape in Europe, which we support, you need to get data from more than 200 SIs. You need to get data from exchanges in more than 25 countries in Europe. So it's not an easy task to get the data part right. I also heard from Marcus and Tillman, and I think this is super, super important. We need to have a useful consolidated tape. We need to have data from not only the exchanges and MTFs, we also needed to get it from SIs and OTC. Without data from SIs and OTC, the tape will be useless. So it is very important that the tape covers everything. And that's back to the use case. And by the way, I agree with Stephen that when we discuss a consolidated tape, it also makes sense to not only think about equities. Fixed income could easily be a part of it as well. And of course, to add fixed income to the consolidated tape, that also just adds complexity around data and the different sources for where you get the data. But the use cases for consolidated tape, I think Marcus touched upon it already. For me, it's around securing best execution or have a better view on best execution, executing on trading surveillance in Europe. Think about it today. Listed companies today do not have the perfect picture, full picture of trading in their shares on a daily basis. A consolidated tape will, of course, should help a listed company to see this is all the trading done in my share today. It's done on XYZ venues. That part is a key part to give the full picture for listed companies. On the investor side, I have a little bit mixed feelings around the consolidated tape. If you look at it from a retail point of view, and I represent the exchanges in the Nordics, if you look at what we offer today, we offer retail data for retail customers, best bid and offer in Denmark, Sweden, and Finland for €1 a month. I'm not sure an offering with a consolidated tape in Europe will give that much to what the retail customers in the Nordics needs. So I'm a little bit mixed views on the use case from retail customers. I'm not sure a European consolidated tape would help on that. That's also why I'm saying the idea of a consolidated tape we support. Let's start with a post-trade. I actually like the idea from Oliver Wyman with 15 minutes delay. So we secure at least you have the total picture of the trading day. You avoid the big discussion, and it's a tough discussion also in US around latency. So you have something that you have a consolidated tape, but avoid the discussion around latencies to begin with. You make sure you get all the data, all the right data, not only equities, but also fixed income. And then you can gradually move closer to a post-trade real-time tape. So I think overall, I think this is a very interesting study. We agreed on most parts of it. That's something that we also would like to investigate further. But the quality of the data and that you have all data from all venues, also SIs and OTC, is a key part of us. And I think also the tape should not only be equities, also expanded to fixed income. So that's my key point.
In the sake of time, I'll probably ask Santi already a question a little bit around the second topic I want to discuss, tape options, benefits, challenges, and costs. I mean, there's the four different uses or options, that are discussed in the study: pre-trade, post-trade close to real time, post-trade 15 minutes delay, post-trade end of the day. We heard from Sean, he's thinking about a tape that would be seconds from real time. And also we got a few questions from the audience. Stephen McGoldrick from BNP, for example, asked, 15 minutes delayed already is free. Why hasn't it been built? Well, I would assume because, for example, SI and OTC is not available. David Barnett asked, real time and the 15 minutes delayed, why is there such a high cost difference in the study? I think you've looked a lot, I know, at the different options and benefits. What do you think is the optimal end of day, 15 minutes delayed, the second version that Sean was entertaining?
Oh, thank you, Rainer, and thank you. Good morning to everybody. Oh, yeah, I think that the study has a very comprehensive view of all the benefits and all the costs for each of the options. And the study begins with one premise, is that there is no a regulatory mandated case like in the US for the tape. I mean, there is a mandate to create a tape, but the tape is not designed to solve some specific problem, like, I don't know, in the US, the VEX execution achievement. So the study believes, and I agree with that the tape should provide a comprehensive view of all the trading in Europe. That's right, and give an independent source of data in order to streamline some processes that currently need information to be sourced from multiple sources. I agree with that, and I agree also that the four options that are put forward by Oliver Wyman fulfill those objectives in principle. So now, going between benefits and cost. First of all, it is very striking that none of the 40 institutions interviewed by Oliver Wyman favors a pre-trade real-time tape because of the technical feasibility, because of latency issues, because of geography, Europe, because of having 600, 400 trading venues plus 200 systematic internalizers. That makes the creation of a pre-trade real-time tape almost impractical, or, as the study says, impossible. Now, with regard to the second option of a real-time post-trade, I believe obviously it is feasible. Post-trade does not need to go to the nanosecond as currently is now habitual in the equity market, but anyhow has a number of challenges. For instance, in my view, the cost provided by Oliver Wyman for running a post-trade real-time tape are quite low. If you have real time, and I manage a company that provides real time for all the data by BME, you need much more staff, much more personnel in order to monitor connections, in order to monitor systems, and also in order to provide decent client support. Because if the clients depend on you on having real time, and in the very moment there is any sort of delay, I don't know, half a second, imagine, which today half a second is a huge amount of time in current markets, the telephones will start ringing. So the level of attention you need to devote both in the operational side, but also in the client side to a real-time tape, even in post-trade, is real high, and it's challenging. You need a lot of personnel. We have to, again, take into account the huge amount of different contributors that have to be taken care of. Now, the third option, 15 delay post-trade tape, I agree with the authors that it's probably the one that will bring more value to the market. Again, it goes with I would say hefty price tag, and the authors, I agree with them, say that the price tag they estimate only takes into account the cost of creating and running the tape, not the costs that are going to be both by contributors, but also by users of adapting to the new system, which could be real high. So even though, well, it has a quite important cost, it is true that if you have something that is in delay, the level of attention, again, the level of support to the clients is not going to be as high as in real time. I don't agree that currently we have that already in Europe. I mean, obviously regulated markets and MTFs provide post-trade data in a comprehensive and I think a quality way, but the problem here is not either regulated markets, not MTFs. The problem here is SI and OTC. And the reason why nothing has emerged today as a post-trade tape, which could be quite easy because all the data providers, all the sources have the obligation to provide this information for free, is that the different companies, vendors or ISVs or whatever that have studied the possibility of creating a tape has realized that without deep changes in the way that SI and OTC information is enforced, I mean, the quality of the information is enforced, they would bring no additional value to the clients. They wouldn't have markets or clients enough to compensate for the investments. And last, the tape of record, which has been advocated by a number of actors, myself as well. I mean, I acknowledge that the user case that can be thought of for a tape are reduced. I mean, a tape of record doesn't serve to everything. It covers a number of important use cases, and most importantly is probably the easiest in an operative point of view and cheapest way of setting on a tape. And again, most importantly, is the quickest. I mean, I think that a tape of record can be built, I don't know, in 3, 4, 6 months, probably like that, with real low running cost. But again, the most important thing, and I have to take into account that no one has come up in 3 years saying, hey, I want to be a CT. So there is no such a strong demand in the market. And in my view, the reason is that without real changes in the quality of OTC data, in the quality of systematic and transit data, in the regime of deferrals that we have today for post-trade data, the value that such a tape would have without these changes in the quality of data would be very little, and probably the success of the venture could be quite low. So we need to fix that first of all.
Maybe to go briefly back to Stephen, because you wanted to comment, I think, again on the options. You had said you would favor a few seconds, so I think you would be more, I think, in line with what Sean has said. But you said you had another comment around the tape options, benefit, challenges, costs.
I was referring. I think as the discussion goes on, we'll probably start talking about ownership and governance and revenue sharing and fee structure.
That's my last round. Yes.
Okay, so I mean, I'll save my comments on those topics until we get to that. But yeah, look, as you noted, I think that a lot of the benefits. Look, I'm happy the study comes down on the fact that we should have a post-trade consolidated tape, and I think the study actually says we should start with 15 minutes and then explore moving to near real time. And I think it's helpful in this conversation and in the study. We've sort of we're not getting distracted by this talk about nanoseconds. Like we're talking about making information available in as close to real time as possible. I think a lot of the discussions around latency are relevant when you are discussing consolidating pre-trade quotes across different market centers, but that nanosecond latency discussion is not relevant when we're talking about consolidating post-trade data to the same degree. And then one other note, frankly, is that like in the fixed income space, where again I think the use cases are quite strong, debating 15 minutes is a little bit of a red herring when we still also need to solve a deferral regime that has most trades deferred for 4 weeks. So delaying something for 15 minutes after it's been delayed already for 4 weeks is sort of a side issue. So I'll pause there for now.
No, I think great comment, and maybe the deferral regime, what is the use case? Let me probably come back to Tillman and afterwards maybe to Marcus. Christian Hölz asked, how do we ensure that a CT is not widening the gaps between professional and retail investors even further? And maybe to tie in what Stephen just said, now we have in the bond market, for example, deferrals of up to 4 weeks. Also in the equity space, we have very long deferrals. So I think there is a very unbalanced way of how things are being disclosed. And currently, if I would see real-time tape, I probably would not see a lot of the reality out there, because a lot of things are under deferrals. And that probably creates a rather unlevel playing field for professional and retail investors as well. So how do you want to address that, Tillman? And what is sort of that retail component of a tape? You're on. No, now you're on.
Right. Yes, there's a teleguided muting and unmuting. So that's so I think the report, that's the one sort of little quibble that I would have. The report seems to still base all these cost assumptions on the nanosecond tape. And the costs that we have collected, which are rather different, are based on a tape which is as sort of speedily as technologically possible after the timestamp of the venue. But we specifically said we don't want an algo tape, we don't want a trading tape. Just say how quickly can you consolidate data if the data were available without any kind of further legal obstacle, and then disseminate the consolidated data flow. And these studies are not relying on nanoseconds. So maybe we clarify with your consultant that all of these very, very high cost estimates, they're still kind of based on the nanosecond tape. Now, I think it's a good question to say, how is this tape going to remedy information asymmetries? And how is this tape going to contribute not to worsen information asymmetries? And I think it's a valid point that has been made by several venue operators over this debate, that the sort of proprietary feed, which is still delivered within nanoseconds, is always going to be quicker than whatever tape we design. There's absolutely no question about this. Even if we deliver this tape within seconds, milliseconds, or as fast as technologically possible after the timestamp, this tape is not a competitor to the nanosecond proprietary feeds that are sold by the exchanges to the high frequency traders. So it's a total red herring to constantly accuse this tape of being an algo tape. And I think the study is still, to my mind, to my taste at least, but I may be wrong, a bit too ambiguous on making that very clear. Our impact assessment will make that very clear. But now the question is indeed how not to worsen already existing information asymmetries, because now we've already admitted that the tape is going to be slower than the nanosecond feed that the high frequency people get from the exchanges. So the high frequency people are always going to have an advantage. And then how not to worsen this beyond what is necessary. And that is where I come in with the 15 minutes. I don't fully see how then making a speed bump into the publicly available tape of 15 minutes somehow remedies the information asymmetry. I think that's pretty obvious. So if you have let me take an analogy. So you have a train schedule and you want everybody to have equal access. And some people see the train actually live as it departs. And some people only get the schedule with a 15 minutes delay. Those are the people who are going to turn up at the quay 15 minutes late and the train is gone. And it's going to be a consistent pattern that they're always going to be late because they only see it 15 minutes later. So in terms of information asymmetries, I think the tape doesn't have to be a nanosecond tape. It's not for the high frequency people, but for everybody else to see, as Stephen mentioned, the post-trade data, it should be as quickly as possible. Why sort of stall these people for 15 minutes, the rest of the markets, until they can actually check what has happened? And if the market moves and if there are developments and you need to execute a trade and you're an asset manager and you basically want to monitor what your broker is doing and you always just get it 15 minutes late and there is an event, there is news, there is an event which influences the price, there are events which influence the liquidity, and you're going to check after your broker and you want to see live what your broker is doing, whether he gives you best execution or she, and every time you are 15 minutes late and you have missed it. And that is, I think, my principal issue still with the delayed. I can see the speed bump and the attractiveness of the speed bump from a revenue perspective, because after 15 minutes, the data is free. And after 15 minutes, you can scrape it together at a very low cost and make it available. And that is already progress. So I agree with the study on that one. But on the other hand, there is still this issue that a lot of people will not be seeing how their trades are executed, will not be able to intervene, will not be able to correct the instructions to their broker, because everything they see is when it's already happened, when it's already too late. And I think that's where we still have to have a bit of a debate.
Do I hear a little bit a best execution use case there? I mean, do you, and we discussed before use cases, but you have not said that. Would you, for example, see that there will be the mandatory use, for example, for best execution verification?
I'm talking about two things. I'm talking about constant sort of discovery of liquidity management, constant management of your risk. This is a professional user tape, absolutely. So I agree that retail benefits are not immediate. They will be trickling down, but the immediate benefit of a faster tape would be a professional tape. So it is intraday liquidity management. It is looking at trading opportunities before they're actually gone. And it is, of course, and there you're right, Rainer, it is also a bit checking live on your broker whether he achieves best execution or whether he consistently misses huge available liquidity because he's not connected to a particular venue. So it is also the live monitoring of best execution. But it needs to be in proximity to what is actually happening. I really don't see for a professional user how it can be useful if everything that the professional user sees is artificially delayed, because it will be always too late. The train will have departed by the time the professional user sees it. So I guess, to put it diplomatically, because we are reaching consensus, so I don't want to destroy consensus, which is on the horizon. So to put it diplomatically, we would then have to sort of be very careful on what use case we define. If we say intraday liquidity management for large trading orders, which are mostly for asset managers, pension funds, is not a use case, it's only ex-post verification, then I think the 15 minutes would be nice for retail. At least you have a consolidated view after 15 minutes and not just a venue-specific one. If you want to go one step further and also do one for our industry, for our competitiveness, then I think we need to have this debate that we show the asset managers a sort of near-life picture on how their trades are executed and whether all the liquidity that is available is actually sufficiently exploited.
Marcus, any reactions to the retail dimension?
I think what Tilman said is very clear, and I can fully share, but coming really to the best execution issue, which I will not see only as a consolidated tape issue, because it starts to be really have a fair and transparent price building process if less and less trades take place in those markets where we get data and data access for the retail investor as well. And of course, with new technologies, we have this issue of payment for order flows, for example. The question will be whether best execution is guaranteed. Sorry, I have craftsmen in the house, and it's very difficult to get craftsmen in Germany at the moment, so I will not throw them out. I hope they stop immediately. So coming back, best execution has to be addressed on a lot of areas where we can establish better circumstances, and consolidated tape is not the key issue to achieve that. I think there are other areas to be addressed. But of course, we have to be aware, and that is what I fully share what Tilman has said, that we do not create an asymmetry of information for a few in comparison to a lot. And therefore, I hope that what Tilman described will be the content of the proposal of the European Commission.
Good. We have only 12 minutes left, and one important topic to discuss, governance and risks. And I think Marcus also, I think in his introductory words said, we need to be realistic and sort of see how this is managed. Sean Berrigan was more in favor of actually competitive tape providers. Maybe Björn, you want to take a start on this? Governance and risks of a tape. What is the ideal model and why?
Yes. So first of all, I just want to highlight that when we discuss the consolidated tape, this is not the silver bullet to solve the different issues around a competitive capital market in Europe. I think actually Stephen touched upon deferral regime for fixed income. We talk about consolidated tape. If you want to build that, there are a couple of things that we need to solve as well. So consolidated tape is not the silver bullet. It's a part of a better capital market, but there are many other things that we need to address. So let me just highlight that. So let's not only focus on the consolidated tape. It was also important what Tillman said. A consolidated tape, the benefits from a retail point of view in my world, and I think that was also what I heard from Tillman, is limited, at least to begin with. So I think that's also important. So the consolidated tape is not to help retail investors going forward. At least it has limited benefits. So when we look at the governance and structure for a consolidated tape, you can discuss, should we have one provider, should we have more competitive providers, or so more providers? I think actually to make sure we do it right, I'm probably in favor of having one provider. And I think actually if you look at the size of the market and to build it, it's probably easier and better to start with one. So I'm leaning towards that. I do not have a clear view on it, but I think that's what I'm leaning towards. I just want to touch upon one thing that was also important when we look at the governance and the structure, and that is we have a long way to go. So just to build a consolidated, sometimes when I listen to Tillman, it sounds like it's just so easy to do. It is not. We need to get the data from so many different SIs, venues in Europe to get the data right, to consolidate it and distribute it. It's not an easy task. It's not something that is just done. So it's something that takes time. So I'm leaning towards it probably should be under ESMA, that the government should be, where we need to have the different stakeholders, key stakeholders that submit data to the tape that will be a part of it. And then I'm leaning towards one provider. But it all depends on the structure, how we do the consolidated tape. Whether it's only equities, is it equities, fixed income. So to discuss the governance structure, it's a little bit difficult to be clear about before we have seen the actual final proposal, final outcome on what does the consolidated tape cover and how is it designed.
But actually, to make that comment, Liz Carter, and I think we've addressed it now a bit more, had asked that we also discuss a little bit bond market, that they behave very differently, and that obviously that needs to be addressed. I think Björn, you've said it. Stephen has said that. So I think obviously fixed income markets are probably the markets where a tape will be more useful, and I think that's what also Thomas and Sean had said in the beginning. Stephen, you want to comment a little bit on governance and maybe risks of a tape, how to calibrate that?
Certainly. So I think to pick up on comments that have already been made, I think it's probably optimal to have one provider or one tape per asset class, but we don't need necessarily to have the same tape or provider for each asset class. So, just for reference, in among the consolidated tapes that exist in the United States, there's separate tapes, separate operators for equities, options, corporate bonds, municipal bonds. So I think that's logical, and you have to sort of calibrate those tapes and design them appropriately for each of the markets. I think it's fair that raises questions about whether there's then adequate competition and innovation if you do not have competitors. But I think you just have to find other ways to solve that. With a recurring competitive tender process, for example, or fixed terms of 3 to 5 years or whatever for each go around, and then frankly, to the fact that you do have multiple providers operating tapes in different asset classes, you do have a stable of competitors who may want to expand their capabilities over time. I think on the ownership and governance front, this is a key consideration. I think these can be effectively done by a regulator with an outsourced technology, but equally can be done as a consortium of market participants or a private enterprise. But I do think in all circumstances you do need transparent rule books, transparent fee filings, and a process for public input on those dimensions to make sure that there's adequate public input and oversight of what's happening. So, and then I guess the last point in terms of the structure that I think is important to consider is how any sort of revenue sharing works back with the contributing venues. And I think this is an important issue, but also one where we need to again, I think the right framework, it depends again on the asset class we're discussing. I think the revenue sharing arrangements and the logic behind them is very different in an exchange traded market versus an OTC market. So it's very different in equities versus fixed income. And I think it's very different depending on, and I think in this case, we're mostly talking about post-trade data, but the whole revenue sharing concept is, I think, much more driven, frankly, again, if I'm looking at in the United States, it's much more driven by the fact that there's a consolidation of pre-trade quotes, right? So I think again, the whole revenue sharing debate is really, in my mind, more centered on if you're consolidating quotes for equities than if you are consolidating post-trade executions in fixed income. And again, just as an empirical example, the post-trade tapes that exist in the fixed income markets in the United States have no revenue share. So it is the revenue share debate, I think, is specific to the exchange traded markets.
Santi, governance and risks.
Oh, governance. I also believe that the tape should be governed probably by some pan-European institution that has power or has a potential power to enforce the data quality of the source, which again for me is of the essence, is the cornerstone of the tape. If we want tape to be successful, with regard to multiple tapes, I believe that I agree that a possibility of having different tape providers for different asset classes. I don't think it would be sensible to have tapes for the same asset class, given that the demand is quite low today. So they will be competing for not a huge pot of revenues in order to cover the cost. So I don't think it's sensible to have more of it for a single asset class, but it could be for multiple asset class. Having said so, and I've been in the market data business for many, many years, market data is an industry of scale. So having just a single tape could some benefits in terms of savings. But again, both possibilities are all right. Obviously, they should be a voice for both the contributors and the users in the governance of the tape by means of probably an advisory board or other figure. I think that's important. And lastly, with regard to the revenue sharing, I believe that if we want to work towards the objective of MiFID, of having more transparent market, of having more market integrity, I think that remuneration should go mainly for the venues that perform price discovery, not for all sort of venues. I think it's important. And also that the tape has prices that allows the tape to have some profits. Otherwise, if you have a tape that has no profit at all, that would be also unfair with the rest of the ecosystem in the market data business. That means vendors, ISVs, and there is an industry behind. We suddenly create an animal that has the data for free, that provides a consolidated view of data almost in real time. We have to calibrate the sort of effects that could have within the rest of the market data industry. It's important that the tape, the objective of the tape is to have a comprehensive view of the trading in Europe. The tape is not thought for lowering the cost of market data to users. For that, there are other measures like the ESMA reasonable commercial basis provisions and many other things. But the tail objective of the tape is to have a comprehensive view of the trading in Europe. So for that, it should compete with the rest of the industry. Risks. I think that in the last chapter of the study, they detail quite well the number of risks that can be that we run if we design badly the tape in terms of market integrity, in terms of segmenting the market between the high tier market of very sophisticated investors and a lower tier market of retail investors, in terms of introducing perversing incentives for the tape. And it is very, very, very important to take into account that the smaller venues, there are a number of smaller venues in Europe, small regulated markets, small MTFs that make their living probably mostly on market data. And if you are too aggressive introducing the tape, probably the big companies with the big exchanges could live with that. But I don't think we want to kill smaller venues that also provide a very good service to the local markets and also to the rest of Europe.
Thank you. Tilman, governance. I mean, Sean was more for competition. What's your view on that? How to best govern it?
I think before I come to the nitty-gritty of governance, I want to answer to Bjorn on his point on retail investors, because I think it's an important one. The thing with retail investors is that they will have significant benefit if their intermediaries have a better view of the market, because most retail investors are invested in ETFs, or most retail investors are invested in a fund product. And if the fund manager can better manage the liquidity of executing the trade, there is a direct, of course, positive ripple effect on retail. Putting it the other way around, why would European asset managers, when they invest in European equity and trade in the European Union, why should they have a worse liquidity profile, a higher liquidity risk, a higher trade execution risk than their American peers who invest in the same type of funds? I think that is really the question. If we want to have more funds with a European investor profile, with European equity in it, we have to create for the main participants in this market, which are the asset managers and the pension funds, a trading environment that is just as competitive as in the United States. And if you want retail to have more pension security because there is better fund, there's more ETFs out there which they can invest in, these managers need to manage the liquidity risk. They need to manage the risk of often transacting huge volumes on behalf of millions of investors. And therefore, this strong emphasis on the intraday liquidity management, big asset managers do need to see what's happening throughout the day. And if there's a speed bump, that will make it very difficult for them. And the other thing is that we've seen in America again, that retail investors do care about timely information. I think that a lot of retail investors who invest directly, they do subscribe to the tape in the United States. There are 4.5 million of retail subscribers to the tape, and all the people who do online brokerage, they get access to the tape via their broker. All the retail investors who subscribe to an online broker get the access to the tape because of the vendor display rule. So they have to show the retail live what they're doing. They have to show retail live on how they're investing their money, how they're executing their orders. And I think that has stimulated more retail interest and more retail participation in capital markets. So again, we want to show the retail a reality which is as close to real time as possible. We don't actually systematically wish to disadvantage retail by showing them everything with a speed bump, whilst the professionals can see it much quicker. I think that is the basic ethos of the tape. We can then sort of quibble around the sort of delay and how we structure it, but having a delay which is significantly longer for retail to see what's happening with their order in the market than for the highly sophisticated professional does create information asymmetries and does create a certain amount of skepticism about participating in the market. If you always know that somebody else has a better view and can trick you and can front run you and can do lots of things with you, you might not be as inclined to go to the capital markets. Now, on the governance, I can see that you can have a very interesting debate on competing consolidators versus a single consolidator, continuity of business, competition, innovation. I don't want to dwell on that for the principal reason that I had to spend all of my summer holiday doing this investigation because our economic assessment board is terribly interested in this kind of stuff. I will have to just refer you to the impact assessment. There are pages and pages on this thing, pros and cons of having several competing consolidators, of having a tender process, as Stephen mentioned, of having ESMA do it. Really, just read the impact assessment. It is just too dull to explain all the details of this. What I can say about this is that any kind of decent legislator who is worth his salt will not go for a specific option, but will say, if you want to be a consolidator, you have to go to an ESMA registration process, and ESMA will then publish all the registered consolidators, and if nobody goes through the process, well, then ESMA will tender it. So there is a simple solution to all of this on how to get this done in practice.
Thank you. We're over time, but quick comment from Björn.
Yes, I think I need to respond on the comments on retail. I think the comparison to US, we have to be careful. Retail investors in the Nordics, which I represent, I work for them and for the online brokers every day. They have access to real-time data today. They have that today. I'm not sure if you're retail investors in Sweden that you need it for shares in Spain. I don't think their buying interest in Spanish shares is that high. So I'm not sure a consolidated tape covering shares in south of Europe is to the benefits of retail investors in the Nordics. They have that today, and they pay €1 per month. So I don't think you can get it that much better. One final point is, if we want to have a consolidated tape where we know there's a consolidated tape and then there is a data feed directly from the exchanges to the professionals, then you won't be too late anyway. So the comments about if you're sitting and it's a 15 minutes delayed, then you will miss the train. You will also miss the train if you're 30 seconds too late. So I don't think actually the point around 15 minutes versus 1 minute is super relevant, because my point is you will still have some professional market participants that will have the faster tape, faster access to data. So I'm a little bit concerned about just thinking about it will be equal for everybody. It will not. And that's a key point as well. So it's not to the benefit of retail, consolidated tape. I doubt that. And I think that's a very important point. But I like it. I support a consolidated tape. I think it's better for Europe. But let's not fool ourselves that it's to the benefits for retail. It's to the benefit for the broader market. It will help the listed companies to have better access. Hopefully, it will create better price formation, better transparency, also longer term, better data on execution. That's the key part, and that's why we support the idea and the concept around a consolidated tape.
There's just one point I want to make, Björn, about the retail investor profile. There are lots of retail investors who take an enlightened view. They are in the European Union, and they do want to invest outside of their home sphere. I mean, I also have tendencies to want to invest only in Swabian mid-cap companies, because that's where I'm from. But sometimes I sort of rise my perspective, and I can see that there are other member states, including Spain, which actually offer quite attractive investment opportunities. And if they would be on one tape, I might actually tap into that potential. So in that sense, I think we are underestimating, as is said very often in this debate, we are underestimating the sophistication of at least one chunk of our retail investor population.
Well, let me maybe conclude. I think we're a bit over time, but I think it was a fantastic discussion. We see there is a lot of common ground, but there's obviously a lot of fine details further to be discussed. Markus Ferber already had to leave, but a big thank you to Björn, Tillman, Stephen, and Santiago for participating, as well as Markus Ferber, who had already had to leave. Let me say it was a lot of fun. I'm already going to say goodbye. However, we still have the closing remarks from Anthony Attia, FESE Vice President, and also the Global Head of Primary Markets and Post-Trade of Euronext. I think was a very informative 2 hours. And Anthony, you've watched it all, so I'm very curious to hear your perspectives. Goodbye from my side.
Thank you, Rainer, and I hope you can hear me well. I did follow the debates very closely indeed, and I have the difficult task to kind of sum them up, while also summing up the position of FESE, his vice president. So first of all, good afternoon, everyone, and again, I think we had a very, very interesting debate. It was enlightening. It was supporting the views of all the stakeholders. So I felt that we come up from that discussion more informed. Let me start up with a wrap up of the main highlights of today. So first of all, Rainer introduced the topic of today's discussion and pointed out that what is in the view of FESE the core priority of the MiFIR review, strengthening the rules in equity market structure to provide issuers and investors with a more transparency trading. In line with the core objective of MiFID II, the MiFIR review should focus on the redesign of equity market structure to increase transparency and make markets accessible and fair for all investors. A well-functioning price formation process is key to the stability and resilience of capital markets and has a positive impact on the cost of capital for the broader economy. Concerning the consolidated tape, the views of FESE are that we must strike the right balance. The Oliver Wyman study is a very important contribution toward making the right choice for Europe, improving transparency and avoiding the drawbacks of unnecessary costs or risks that are wrongly designed, that a wrongly designed CTP could bring. And as Maini pointed out, a poorly designed tape risks undermining the development of the local ecosystem for capital markets. At FESE, we have spent a significant amount of effort, time, and energy to input, support, and comments on the Oliver Wyman report. We do believe that it brings a reasonable view of the situation, and again, to go back to the summary of the day during the Fireside chat, we heard that the CMU action plan is closely linked to the upcoming review of the MiFID II framework. Transparency and orderly interaction should be encouraged to allow for a robust liquidity and price formation process. The continued fragmentation and darkness of the markets are harmful as this weakens market prices and increases cost to investors. And then the panel discussion showed that the positions of different stakeholders have a lot in common. Mandatory contribution seems to have full consensus. The discussion on use cases remains an important one. We need to make sure that everyone in our financial market community understands why we are doing the CTP. Governance, information, data standards are all crucial features of the tape, as well as the delay and its shape. The panels also got into a very interesting discussion around price formation and what it needed to consolidate data in good fashion. It was agreed that quality data and correct flagging at source for systematic internalizers and OTC is paramount. A word of caution to legislators about getting an ill-designed tape. And I know we've been talking about that a lot, but I feel it's really, really important. As Marcus Ferber said, the remedy can't be worse than the disease. But it is not an EU consolidated tape on its own that will solve market structure issues. As FESE Vice President, let me briefly reflect on a few key points from our perspective. MiFID II and MiFIR have not yet addressed their major policy objective, which is to increase transparency and bring more trading into the light. On the contrary, Europe has become a darker place, more fragmented and over-regulated in some areas of our value chain. According to ESMA figures, we have witnessed lower levels of transparency and a drop in the market share of lit trading to 40%, with a significant share of trading volume still being executed in the dark. I'm talking about 27% in OTC, 20% of total trading account for SIs, while dark MTF trading is at 5%. Therefore, a precondition for a meaningful tape is to address the challenges raised by fragmentation and opacity, and to ensure a level playing field and a well-functioning price formation process to the benefit of European issuers and investors, particularly retail. Data quality originating from OTC and SI trading remains deficient, with mainly results from fragmentation, exemption from the transparency regime, and lack of enforcement of the rules. Therefore, data quality, consistency, and availability at the source has to be improved as a matter of priority. Without doing that, a consolidated tape will not succeed. Exchanges support companies to raise capital by listing on public markets and afterwards be traded in the marketplace by investors. This is our DNA. This is our raison d'être, as the French say. One of the key activities of stock exchanges is orchestrating the activity on SME primary market. This includes education, promotion, marketing of issuers, and communication with banks. Without exchanges support, there would not be any kind of SME market in some countries. Needless to say, this activity is in the short and medium run cross-subsidized from other sources of income generated by exchanges. And again, this is our job to do it. Exchanges fully support the principle that all investors must have easy access to high-quality market data for the entire market. Whether their trades are routed to regulated market or to dark venues, they must be able to verify the execution quality of each transaction to ensure they truly receive best execution. Let me outline 3 things to keep in mind. First, the tape must provide a consolidated view of the market and empower investors to verify how, when, and at what cost transactions were executed. A consolidated tape is not a trading mechanism, and I think we all agree on that, and will not remedy issues around market fragmentation, transparency, or outages. Second, to enable this consolidation, inconsistent reporting and the lack of quality data of the SI and OTC trades must be addressed. We've been repeating ourselves there, but this is critical. And third, mandatory consumption of the CT will allow investors to have a better view on the market, i.e. where the traded volumes actually are. This will allow them to adapt their trading behavior and improve overall market transparency. I see that as a kind of a mapping of the liquidity in the European market. The revenue for this consumption should provide incentives to lead trading and price formation and be based on a simple allocation formula. To conclude, a market structure fostering transparency together with a post-trade tape could reinforce one another to the benefit of investors and companies. The EU is at a critical moment to push the CMU in our new reality without the UK, and most importantly, to make Europe resilient and competitive. We are leaving the health crisis behind. The opportunity is great, but let's make it happen. I want to thank all our speakers. I want to thank all our speakers and thank you, the audience, for participating. And see you next time for the next FESE conference. Bye-bye.